Welcome back. My name is Chris Achinelli. I get to build, buy, and sell some prop businesses every single day. And today we're going to be talking about business funding from a very high level so that hopefully by the end of this video, you can make the right type of capital choice for your business. Quick preview, what we're going to get into. We're going to talk about 7 different types of capital that's out there for small business owners to be able to choose between, right? So if you're an entrepreneur, maybe you've been in this game for a little bit or you're just getting started, everything starts somewhere and that's perfectly okay. At some point in time, hopefully you're going to have to make a capital choice for your decision, for your business. And the reality is each business is different. Each business is like a different type of vehicle. Some are rocket ships, some are steam trains, some are cars, some are boats, right? And we as entrepreneurs, we're the drivers. And we are drivers that have to get to an end destination. And that end destination is our ability to get there within whatever vehicle we specifically have. And every business is different, right? And just like a rocket ship and a steam train, you would not take jet fuel and go put it into that steam powered train because things may blow up and you definitely don't want your business to blow up. So it's really important to understand the different types of options that are out there in terms of the capital choices you can make, because your capital choice matters and you need to make the right choice for your business at the right time, right? When we're choosing the different type of funding options that are available out there, a couple of things we need to take into consideration, things that I want to touch on in today's video, right? So over at Bootstrapper Capital, if you're in the community or if you watch the content that we create here on this YouTube channel, you know we are all about risk mitigation, because if you can take the risk down, the likelihood of increasing the results or the reward, higher, right? So you want to decrease risk. Intrinsic within decreasing risk is creating value, also building equity, right? And when you're looking at the capital choices, you're trying to make a risk mitigated decision so that you're not adding undue burden or stress onto your business by the capital in which you take in. You want that capital to be an amplifying, a fuel towards your growth, right? Part of the consideration becomes, what stage of growth are you? Again, if you're familiar with our content or you're in the community or you're one of our portfolio companies, you know that we believe there's 5 exits of ownership, right? And each exit is a different stage of growth, really. It's a different stage of maturation of your business, right? And we all have to navigate through each of the 5 exits of ownership. And depending on our stage, different types of capital makes more sense, right? So you really want to understand not just the type of vehicle you're in, but also the stage of that vehicle, right? Or the growth or the exit of that vehicle. And then you need to take into consideration other things, because like anything in this world, there's a give and there's a take. And if you're taking capital in from the market, and we'll just label the market as an investor, right? But really it's the market, and markets get made. There's a supply and demand. And the better you understand the way the market gets made, the better you could actually leverage that to your advantage and let that market get made in your advantage. But we'll just label it as investors. And whenever you take capital from investors into your business, there's something that you're going to have to give up, right? There's always a give and a take, right? That's the way most deals work. So I want you to understand the consequences of the decision. And, when we're looking at it, the first place that most folks are going to start, and it's where we very much so promote folks to start over at Bootstrapper Capital, is pretty near and dear to our heart, is bootstrapping. And bootstrapping, is really fundamentally what we believe to be a less risky approach to capitalism. We believe that regardless of the type of business you're building, even, if it's some sophisticated AI for whatever, at this stage of the game, pretty much every business could start, being bootstrapped, which is really just a self-funded approach, right? You are your own first investor. You're an investorpreneur, and you're trying to take a very lean, mean, focused approach to building your business and getting to a level of traction, right? Without taking any sort of outside capital or liability in first. So you're really your own first investor when you're bootstrapping, and you're limited to the resources that you have to be able to allocate and invest in your business. A very, simple way of just getting started could just be as simple as, creating a social media account and starting to put some content out and seeing what the engagement is, or launching a newsletter and seeing if you can get subscribers to your targeted messaging, your ICP, and then you could eventually convert those subscribers to paid customers, right? There's always ways to start simple, keep it simple, lean and mean, build some traction, take risk off the table, right? So when you're bootstrapping, the pros typically are that, because you haven't raised any money, there's nobody else involved, and you have all the control, you have all the say, and it's your business, right? And for a lot of entrepreneurs, that's important. It's an empowering factor. Many of us are in business ownership because we do want to be our own boss, right? Freedom to decide. Freedom to decide is a very powerful thing. And, we try to promote the fact of freedom to decide by earning it through profitability, over time, and truly having the bankroll, the wallet to buy that freedom, through a profitable business or portfolio businesses. But bootstrapping can put you in that position early and often, and because there's no outside investors, there's nobody else involved. There's nobody else to take into account in terms of having to pay or share, right? There's no interest payments because what we're going to get into debt. There's no dividends because, a couple slides we're going to get into equity. There's no sharing of who's saying or has a say into the vote or the decisions of what's being done. However, con side, wherever there's a pro, there's usually a con. You are taking all the risk. So the risk is on you, right? You bear the burden, which, to be perfectly honest, why not, right? And if you're limiting your exposure and you're making good time the decisions when you're just getting started, you shouldn't really have a ton of risk to have to bear, especially to prove out the concept and bring some of the market successful, right? Sell it, deliver value, right? Validate it, and then build it, So it should be okay for you to be able to bear those risks. But at the end of the day, the risk is for you to burden and bear. Now, typically, once somebody gets past bootstrapping, we're bootstrapper capital. So you got bootstrapper in the name, but you also have capital. And we do promote the fact that most folks, if not everybody, at some point should go out and source capital to be able to grow and build a better business, right? We just want to do it in a less risky approach. Typically, after bootstrapping, the very next thing somebody will do, if they're a small business, if you're a small, medium-sized business, a non-venture backed velocity, high growth business, will typically be debt. Most businesses are funded through debt, not equity. Equity is going to be the very next slide we're going to get into, but debt and equity are the two most common tracks that anybody's going to ever follow. So we're going to cover those first early and often. In terms of debt financing, debt capital is the ability to bring in capital into your business without having to give up ownership. However, the flip side of that is you need to pay back, your lender, right? You are now a borrower. Somebody lent you that money. You need to service that debt. You need to pay it back with whatever terms, right? So the pro side, there's no dilution. You're not giving up a piece of that pie, right? However, you also have to pay back that capital, that you received. So you need to make sure that your business is in a good position to be able to service that debt. Debt can be very, very dangerous for most businesses, right? If you're not in a sustainable place, if you haven't organized around profitability and have a good perspective of your financials, right, and understand the performance of your business over time, right, with enough data to make sure that you can service your debt without taking on unnecessary risk, there's a really good chance that debt could put you underwater. And a lot of businesses, unfortunately, go out of business because of lack of capital or because of taking on the wrong types of capital. Debt capital could literally strangle your cash flow because, whether or not the money's coming in, you need to service that debt. You need to make the repayment. And sometimes, you may find yourself in a position where you have to pay back your lender or service your debt before you can pay back yourself. And in many situations, you could find yourself taking on debt and working very hard. And if you have a team, it's even worse, because, if you have to ask your team to forego payroll or something of that nature, everyone's putting all this effort and energy, and then no one's actually receiving or reaping any of the reward, right? Debt could be a valuable use, a very valuable a tool for you to be able to use to build your business sustainably over time. if it's a risk mitigated approach to it. Now, when we're looking at debt, the other side or other option that a lot of folks will typically pursue is equity. And when we're raising equity, that's very common for what we'll call startups or venture velocity businesses that are trying to build something really, really big. And the reason is because you can share a piece of that pie, because the concept is the pie is going to get bigger. So even though you're having fewer slices, the slices that you own or the slices you're able to eat are larger in theory or concept. So you're willing to share that ownership. You're willing to sell ownership in your business in order to bring in capital, to use that capital to grow, right? So the pro side of debt, of equity, is unlike debt, you don't have to pay anybody back. It's not in a situation where it's going to crush or cripple or strangle your cash flow, right? However, you are giving up ownership. So you could also be relinquishing control. And depending upon the way in which you raise, investors may end up with more of a say in your business than you would like, right? And your business could very quickly, over time, no longer become your business, right? You can go from being full ownership of the business to just being kind of like an employee of the business to potentially even being fired from the business in which you founded, right? However, if you raise right, if you're making a good timely decision and you're actually raising equity and you're choosing the right type of investors, right? So we'll typically use the terms smart money versus dumb money. Smart money being folks that have subject matter expertise that can help you move you forward in your business. Dumb money being folks that are just providing money, right? If you're raising smart money, then those investors can also bring a ton of additional incremental value to the business beyond just capital or cash, right? So there is a way to actually enhance and grow your business by bringing on the right types of folks. Now, again, with debt, the situation is you're not giving up the piece of the pie, but the ideal typically around a small business is that your pie is not necessarily getting much larger. So small businesses will typically go debt route versus equity route because it becomes very expensive if your pie is not growing and you intend to build a business over, say, 30 years. It's very expensive to give up ownership in that business, especially if the business is not getting larger. Makes more sense when it's truly venture velocity. Now, that being said, though, many folks after bootstrapping, they're going to either go that debt or the equity route. And if they go equity early, even if you're a smart business, you may go that friends, family, and fool route. And friends, family, fool is just the ability to kind of tap into your network and your relationships and get folks to say, hey, like, and trust me, this is my vision and I'm going to see this thing through. I'm going to bring it into fruition, bank on me. And you share that upside with them, right? So typically we're going to say bootstrapping, debt, or equity. However, as of late, Jobs Act, this other option has come into the market, which is crowdfunding. And crowdfunding is the ability to raise capital from a large amount of folks. And they don't need to be accredited investors. So accredited investors are folks that are allowed to invest in privately held assets and get, you could file exemptions for it. And crowdfunding is a way to raise from non-accredited investors in large groups and build community, right? So the pro side of crowdfunding is you can, potentially leverage it as a way to launch lean in a sense and validate your product, service, your idea, your concept, and get folks to buy in as investors and hopefully also early adopters and customers, right? Because it's also available for non-accredited folks, you can, potentially also pull in a lot of investors. And because the pool could be so large, you could also potentially leverage that to drive traction. Now, the cons are it's kind of difficult to pull off, especially if you're early in, you don't have a brand, you don't have a large audience, there's a lot of uncertainty into the business. It's very fairly time consuming to set up. and it could require a pretty heavy workload in terms of pulling off. And then it puts you into different types of situations where you now have to have different types of reporting to maintain compliance, regulatory compliance around your Reg A or Reg CF or whatever, equity crowdfunding route you went, right? So realistically, a lot of the things that you get from a crowdfunding, you can also early and often get just from bootstrapping and building lean, right? And then going either debt or equity or an alternative source, which alternative financing allows you to access funds that are non-traditional to either debt or equity, right? Debt or equity, those are the main routes that most folks will travel across the board in terms of the capital markets. Alternative are alternatives. They're very much so that, right? Instead of going, the fork in the road, route A or route B, maybe you take the side trail, cut through the woods or something of that nature. And from an alternative route, we have the peer-to-peer lending, which has popped up, and that's the ability to just borrow and facilitate, capital from peers in a marketplace, in an open market dynamic. You have revenue-based financing, which is the ability for capital to be, future receivables, future revenue to be purchased by investors up front, and then they get paid back in a prefixed, agreed return on that capital over a period of time based off of a fluctuating percentage of your revenue. You have factoring, which is the ability to sell invoices or invoices, customers, business that you've already closed, and you can sell it now if you're waiting for cash. And you could, you'll sell it at a slight discount, but you'll get the cash immediately. You have merchant cash advances, which is similar to factoring and similar to revenue-based financing, but you're getting a lump sum of money for like future receivables from credit card payments or things of that nature. And then you have your business line of credit, which would be tied closer to a debt, but it's revolving. And it's the ability to draw down a line of credit over time, and you're only paying for the interest on the funds that you're actually using, right? So you have all these alternative financing options that have popped up as of recent that get you beyond debt and equity, right? Crowdfunding can be structured as either debt or equity, right? In terms of the way in which you raise, you have to use certain platforms, licensed platforms, broker dealers, equity crowdfunding platforms to be able to run your crowdfunding rounds. Alternatives are typically structured slightly different, and we'll get into that in a second. In terms of debt, key things to understand in terms of navigating the debt markets, you're going to have certain terms that you really need to master. Interest rates is really the cost of the capital. It's the cost of the money in which you're borrowing. The loan terms are the ways in which it's structured for repayment. Right. So you're going to take in money. There's going to be an interest rate. You need to pay back everything, right? Your principal, the initial money, and then the interest, right? The money that you now owe, based off of your principal plus interest. And then you're going to have to make a repayment back in a structured term, right? So you need to know your interest rate, your terms, and then you're going to want to know if this is going to be secured with anything. And being, secured versus unsecured really means, am I putting up collateral? Am I, as the borrower, am I saying, hey, if I don't make this payment, you can take my home or my car or some other form of collateral, the business, that you're putting up to kind of back or decrease the risk of that capital, right? Now, when you're getting into a loan structure, there's the lender, their goal and objective is to try to reduce their risk exposure as much as possible, right? So they're trying to decrease risk. So they're going to want you to do things like have collateral, right? They're also going to likely have things like covenants that are going to be conditions that the lender is going to set. And there's 3 different types. You can have affirmative, negative, or financial. Affirmative are going to be things that the borrower is requiring you to do tied to that loan. like submitting financial statements, for example, or carrying liability insurance, right? Then you're going to have negative covenants, which are things that are preventative, right? You can't take on any additional debt, for example, right? And then you have financial covenants, which would be like you have to maintain a certain level of liquidity, right? Or certain performance ratios to the business. All of these things are things that you need to take into consideration among more, right? This is what fits on a slide. And this is just a YouTube video for high level 101, right? So there's definitely more in depth, but you got to know kind of the fundamentals, the blocking, the tackling, and where the risk lives. So you always got to kind of follow the money and follow the risk to be able to make a good decision. Now, from an equity financing perspective, you got different types of equity. You have different types of ownership that could be sold, right? So equity financing, typically broken into two different things. You have common shares and preferred shares. Now, when you're selling equity in your business, that means your business is likely going to be formed as an entity, right? Which means you're going to have, an LLC or a C corp, right? And you're either going to have units or you're going to have shares, stock, right? And when you're selling your equity, it's going to be broken up into, different types of structures. So you have common shares. If you're a C corporation, you're going to have common shares, which are, common stock that have voting rights tied to it. And in the common stock, you're the last in line if things were to go bad in terms of a risk. But common stock typically grows with the valuation of the business as the value of the business grows. So that's kind of like the folks that are rowing in the same boat in a sense. Common, right? We're all sitting in the common same section. And then you have preferred shares, which are shares that have a preference tied to it. And preferred shares will typically, they're very similar to almost like a bond or a debt note, but they're structured as equity. And they're going to have a higher preference in terms of payout for things like dividends, as well as if things were to go bad for liquidation, right? So they're going to sit above common shares. They're preferred in terms of payouts, but typically preferred shares are not going to share in the same equitable growth. Now, preferred shares oftentimes will convert, or they could convert into common shares, right? And then they can experience that exponential growth. But when you're first raising, you're going to raise with common or preferred. And tied to all these things are different types of preferences, right? So there's also different levels of preferences that an investor could put on, saying, that add additional types of barriers or restrictions or covenants in terms of the rounds being raised. Now, when we're looking at debt versus equity and you're deciding between debt and equity, it's really coming down to control and ownership, right? And where your business lives, right? So if you're going the debt route, then you got to know that you're making this repayment and your business needs to have the cash flow to be able to support that. Now, the benefit of that is you're keeping control. If you're going the equity route, there's no repayment, but your investors will likely want to have some level of influence on the decision making in the future of the business. You're giving up some ownership and control. So different stage of business, different type of business, one may make more sense, right? If you're in a business that is not producing revenue and profit, right, and you're not throwing off cash flow, then there's a low chance that you're going to be able to service debt. And if you don't want to go that route and you don't want to sell equity, then the suggested path would be to just, bootstrap your way to profitability and build a sustainable bootstrap business that can then, service some debt, right? If you know that you're going to be going the route of not building a sustainable business, or you're not able to get to the level of revenue that's required, within the time frame that's mandated, and you have a good business case to raise equity, then go the equity route, right? But when you go the equity route, don't get trapped into this scenario of having to always be raising and always getting to your next round and not managing the amount of burn, which burn means you're spending more money than you're making. But because you raised money from equity, that capital is there, that cash is sitting there, allowing you to spend, burning that cash, right? And your cash flow and your profitability hasn't leveled out yet. A lot of companies, when they go the equity route, they'll get the money, they'll start spending the money, and then they're not focusing on the right things to build a sustainable business over time. And then they get caught into this trap where they need to now raise their next round in order just to exist. And because they're trapped into this level of existence, they start to build towards the wrong metrics and milestones. They build towards having to raise their next round of equity as opposed to building towards what's building a better business. And that's why with Bootstrapper Capital, we really promote the concept of building a profit-led business from day one, whichever route you end up going, right? So those are debt and equity. Those are most common. And then you got the alternative, right? Alternative is really falls into kind of like a third category, but it's weird because it's a kind of like a mixture. It's like a hybrid of all of it. A lot of it will fall into what would be like a contractual obligation as opposed to traditional debt and equity, right? So it's not necessarily traditional debt because there's not really fixed repayment schedules. There's no interest rate or collateral. Like a lot of the things that just go into the fundamentals of the definition of what is debt won't exist, which will make it a contractual obligation. And it's not equity, traditional equity, because a lot of it isn't tied to any level of ownership in the business. So it really is something else. It's something in the middle. And it falls into, typically, things that are tied around more, metrics driven, measure what matters aspects of the business in terms of performance, right? And then that brings us to our capital over at Bootstrapper Capital, where we've really tried to develop the most founder friendly, the most bootstrapper friendly, the most ownership friendly, form of capital. We want to truly be your capital partner of choice until you no longer need one. We want to be the capital partner of choice for every profit-led small business owner, small, medium business out there, right? So we develop performance-based capital, which is our unique funding option, and it's tied to the performance of your business's growth, and it doesn't have the downsides of debt or equity, right? So how does it work? It works by you getting, capital today in exchange for future performance of your business. And that's going to be tied to revenue of your business, profitability of your business, and equity built in your business, right? So unlike debt, we won't have any sort of fixed repayment schedule. There's no fixed, repayments that you need to make that could, again, kill or crush or strangle the cash flow of your business. All of the repayments are going to be flexible based off of the performance of your business. So it's going to ebb and flow based off of how well your business is doing, right? So it's not debt because there's no interest and there's no collateral. So we're not asking you to put up any sort of guarantees or collateral in exchange for this capital. And there's no defined interest rate associated with the capital either, right? On top of that, you're only making payments when your business is performing. So again, it's not on a fixed, rigid repayment schedule, right? It's tied to the flexibility of the performance of your business. And it's not equity because you're not giving any ownership control, right? There's no long-term stake in your business. So as you continue to perform and you're doing better and better and your business is growing, hopefully that pie is growing over time. And if that's the case, you get to keep it and eat it all, right? You're not sharing a slice of that pie, even though we're all tied to the performance and the growth of the business and making sure that that pie stays whole, right? What it really is a contractual partnership. And we want to really emphasize the word partnership. So at the end of the day, we're coming in as performance-based partners. We want to partner with you to align into your business's success. And we want to be able to share in the benefits of the growth of your business, right? So we want to agree to repayment of the business, and we'll set a repayment target of maybe 1.2 times, maybe 1.5 times, maybe 2 times, whatever the capital is, and we'll make it always affordable and flexible based off of your profitability score, So as we come in and we work with you to build equity, the goal is to unlock capital. And then the capital that we're unlocking is tied to the profitability score that we're benchmarking in your business as we're building that equity. And the higher the profitability score, the lower the overall repayment, right? So you can actually bring it down to be extremely affordable. And for some folks, it could be essentially virtually, a 1 times multiple repayment if the risk ratio is low enough, right? And as we're working together, our goal is to grow the incremental revenue of your business, which is how we get repaid, but tying that to a performance basis of building equity and increasing the overall profitability of the business at the same time, right? So it's quite literally aligned. It's hyper aligned. And then once, we get repaid back, whatever that set target amount was, that agreed upon term within the contract of the partnership, we're out. And you maintain full control of the business, right? So there's no dilution. So we're quite literally aligned into all of the right levels of things. We're aligned into growing the top line, we're aligned into growing the bottom line, and we're aligned into building equity over time. And that's why we really look at it as a long-term capital partner. We want to be the capital partner of choice. And we're focused on long-term capital, right? We want to work with folks that are looking to build long-term equity. That's why we also provide long-term equity management over at Bootstrapper Capital, because the capital choice does matter, right? So each of these funding options that we went through today, every single one has a unique benefit. Every single one has a pro. Every single one has a con. At the end of the day, you need to choose the one that's the right one for your goals, right? So every business is unique. We're all separate, different types of vehicles. We all require different types of, every business requires different types of fuel. And as a driver, we also want to decide the road in which we want to travel, right? And different types of partners or different types of capital, partners out there provides a slightly different types of journey, right? So you want to make sure you're choosing the right journey for you and your team. The business is the right type of fuel, and that the tolerance for risk is there, and that your business can bear it, right? So at the end of the day, with Bootstrapper Capital, that's why we focus on helping folks build equity so that they can unlock capital, because we want to get you to build equity to get capital ready, because not every business is capital ready. And we see a lot of folks that go out there and are able to raise debt or equity capital, or they go the alternative capital route, and they really shouldn't. And just because somebody offers them money, they feel like, oh, this other person, they're a sophisticated investor, or they have the capital and they're offering me capital. That means I'm ready for this capital. And they end up raising wrong. And when you raise wrong, you're putting yourself in, likely the wrong type of fuel for the wrong type of vehicle, or you're putting the wrong type of vehicle on the wrong type of road for not to the journey in which you're looking to travel. And that's where a lot of businesses or vehicles break down, right? So you don't want your business to break down on the journey that you're traveling. You want to be able to trust the process. You want to be able to commit to the journey. And that's why with Bootstrapper Capital, we start simple. And we start by working with you, your business, to really understand the business, to figure out how to build equity. And we created a ton of IP. We created a proprietary process to be able to benchmark the value of your business and the ability to build equity or increase the value of your business by increasing and benchmarking your profitability score. And we work with you to increase your profitability score over time. And as you increase your profitability score, you ultimately build equity in your business by reducing risk in your business. Lower risk, higher profitability. You're building equity, and then you can unlock capital. And when you're unlocking capital with us, it's the performance-based capital structure. So we're really trying to align interests in all ways, shapes, and forms. And if you want to, you can start building equity for free. We want to make it fun, fast, and free for people to build equity. You can go over to bootstrappercapital.com, where we are trying to make it fun, fast, and free through our community for everybody to build equity so that we could ultimately unlock capital. We're working on pretty cool stuff. We're trying to take our analog process and approach, and we're trying to really kind of bring it into the new world, which is bootstrapper.ai. So we're taking all of the things that we're learning and lessons that we're learning, and we're building and developing what we hopefully will be an automagical experience in terms of a platform that truly just makes it really fun, fast, simple, almost autopilot, to put the profit in your pockets on autopilot to build equity, unlock capital. Thank you for watching this video. If you watched it to the end, we appreciate it. Always looking for feedback. Provide feedback in the comments. We want to make this as enjoyable, right? We're making it as fun, fast, and accessible as free as possible for everybody to create as much value so that you can ultimately trust the process, commit to the journey. Till next time.